In this video, traders, we're going to look at the ATR trading stop. Stay tuned. Hey traders, a very warm welcome to you. Alright, so in this video we're going to look at the ATR trading stop. Now this video is sponsored by CoreSpreads Australia. There's a link to those guys in the description below. Go in the description, hit the link, check them out, see if they're right for you. Go and check out the spreads on the markets you trade and maybe consider them as your broker, maybe backup broker, primary broker, whatever. But they've got to be right for you, and go and have a look on the site and see if they match the type of trading that you are doing in the markets that you're interested in. But what I'm going to do in this video is I'm going to use their CoreTrader 2 platform and the charts on the CoreTrader 2 platform to look at the ATR trading stop. So the ATR trading stop is, in a nutshell, let's just kind of jump straight to it. It's a way that you can help hold your trades longer. So we have the issue as traders of trying to hold those trades longer. Sometimes we have a price target and we're holding for the price target, but sometimes we're kind of on the end of a trend. We're like, well, I'm on the end of a great trend. Where do I close this? How far do I let this run? Do I wait for a kind of exhaustion move? Do I wait for an X% pullback? How can I guide this? And one way of doing it is kind of using moving average as a trailing stop, and that kind of tightens up with price. Another way is to use the ATR as a trailing stop. So ATR is your average true range. In other words, your range on the day, average daily range, averaged out over the number of days. So a 14 period ATR on a daily chart will be a 14 days of range, the average of that. So if you've got one really big range, then it's going to be smoothed out a lot more. Now, obviously, if you're going on to a smaller number on that, just like your other moving average, and you've got 5 days, then it's going to be more sensitive to current days as it is a longer period. And most people are going to use something like, you could use a 5 if you're very, very short term, 10, 15, most people use 15 or 20, that kind of stuff for swing trading. Now, does this work on lower time frame charts like your 15 minutes, your hourlies? It can do, and there's not really any reason why you can't do it. But for me, I like the fact that range is, a day's range is a bit more a normal situation. You can understand the day's range. It makes more sense. A 15-minute range, you might have a real big candle from news and then nothing. The distance between the two, or the variance, should I say, in range is a lot more, generally speaking, on the lower time frame. So have a look on the dailies, and if you can make it work on the short time frames, by all means. But we'll use the dailies in a moment. So the idea is that it keeps you in the trade. So if you're in a trade and you're just running with the trade, you use this, and this stop will kind of ratchet itself up based on the range. So it's the ATR, and there's a multiple to it. So it'll do 3 times your daily range as a stop. So it means as things start to get really kind of wild, it's wide to accommodate that noise. When it starts to consolidate, it tightens things up a little bit, because the ATR will start to go down a little bit, of course, depending on what period you've got. It'll start to decrease a little bit, multiplied by a multiple, it will start to ratchet up. So what does it? Locks your gains in as the price goes in your direction. Doesn't let price come back massively and give back loads of gains. So let's have a look at it on a few different charts. We'll look at it on some kind of gold and some commodities and indices and stuff, and see how it works. So let's hit the screen. Alright guys, so I've got a gold chart here. If we wanted to put this on, we go to studies and we click on the average trailing stop here, or ATR trading stop, should I say. And the settings, we can set the settings. So I've got the settings at the moment set to 15 periods, so kind of 15 trading days, and a multiplier of 3. You could use 20, I think the default was 21, but it's not going to make that much difference. If you just look, it can bring price up a little bit, but it also get to a certain point where it can move price away, move the ATR away from price, should I say. So just find one for you. Don't start meddling and curve fitting stuff. But I quite like 15 because I think a little bit more of weighting to current prices is better, generally speaking. Unless you want to really kind of look for bigger moves, then of course you can go wider out. But ultimately, the ATR is not going to change that much unless it's really gone from one kind of phase of market to the other. So you can see here, the big thing for gold, obviously, this year is the fact that we've broken out of this kind of consolidation area early in the summer. We broke out of that and we're off, and this really kept you in the trade. Now, people could say you could use it to get into the trade, and you kind of go long when it breaches the buy stop from the short side. Yes, you could. I would prefer to use some other way of getting in the trade and use this to get you out of the trade, but it's something to investigate if that kind of floats your boat. Anyway, this example here, and at the risk of cherry picking, guys, of course, and we'll look at some other stuff as well, this has kind of kept you in the trade and probably almost stopped you out there. I'm not sure, it's going to depend on how close that is. It might just have stopped you out. You might still be in it. It depends on what kind of levels you're looking at there. But the point is, it's kept you in the trade from the breakout area all the way through. So in this consolidation, the ATR stayed firmly here. It kind of ratcheted up slightly when we broke out of here and gave you a little bit of you know, a little bit of extra in there, and then eventually it kind of broke out and then ratcheted up. So the good thing is you can kind of relax with the trade. So you go running with it, you stop sitting there, fine, if it gets hit, it gets hit. But then when it goes another leg, of course, it's ratcheting up again, and it only took a few days for it to kind of move up quite dramatically and lock in quite a bit more profit. And that makes you feel, you know, much more comfortable. And then at some point it reverts back and it'll end up taking out this low if it hasn't already tagged it there, and you'll be out of the trade from wherever you came in. So, you know, of course, we're looking at an example that's, you know, a good momentum expansion trade, and that's the best ones you want to use this on. If you're in a range bound environment, you're putting it chopped up. But it's a way, really, I think the most power comes in of trying to stick with the trade, sticking with the move and running it as far. Because if you're one of the people who kind of takes the trade and ends up coming out at the first sign of stagnation, this will help you, because this has actually kept you in for the second leg and the subsequent moves. So let's look at something like Apple. Let's see if we can get rid of this moving average. So same kind of thing with Apple, guys. You know, let's say you were, you know, buying this here at the start of the year. You pushed in, you're holding it, you're probably just about still in here, and then you end up coming out here. Now, obviously, you know, we could widen this out, but we don't want to. We just want to show the point that, listen, if you had this for a few months, maybe this again would kind of think, oh, I'm consolidating for a month, I don't like it. But if you're using your ATR, it looks like it might just have been clear of that. It means you're still in the trade for the second leg, and that's why it's so powerful. So let's look at something else where it doesn't work so well. So something like a Euro US dollar, specifically at the moment, and by the way, these are all daily charts, guys. You know, the fact that we're in a very, very shallow downtrend. We're almost in a down channel with Euro US dollar at the moment. You can see, you know, we can start to draw perhaps a tool on here. I've got a trend line tool, which will help us kind of visualize what's happened. Oops, let me just make sure I've got that selected, and I need to just click, and then what I'm going to do is drag it back to here. We just click and hold and move. So I'm roughly drawing a trend line there, but you get the idea. So this is where it doesn't work so well, because you're getting rotational markets. So, and same with anything, guys. If you're trying to trade a trend type move in a rotational market, you're going to get stopped out. So you've got to look at it completely differently. This is not something that would work. Now, when it would work was if potentially we kind of broke out of this trend, and I know that's not the best trend in the world, but let's say we had this here, or etc. I know we've got this high here, but you know, poetic license for this one. If we did break out and start to run or to the downside, then it would kind of come into its own more. So be cautious about using it during choppy environments. You can see here, you know, if you got short, you're going to get stopped out pretty quickly. And what you're doing is you're allowing the trades to come all the way back to your entry, because it's a rotational type environment. This works much better in a trending environment. And even cable so much, you know, cable's been a lot more perhaps trending than euro, but even so, you can see that it's sensitive enough that it will ping you out. So, but you know, hindsight is great and say, oh, I would have loved to have been in this. But let's say you shorted this kind of move down here in this subsequent break of here. It's kept you in, you know, not bad. I mean, it's not been great on this. You've left a lot on the table, which is one of the weaknesses of it. But it definitely, you know, it's something to be said for just taking the decision-making process out of your control and putting it into the hands of an indicator. It's like, listen, I'm not going to touch this until the price touches that ATR trading stop. And that can be very comforting and very good for discipline. I'm just showing you on a 15-minute chart. It's 15-minute chart here of USD JPY. Yes, you could use it. Let's say you were kind of looking you know, for a move again after this kind of consolidation, after a push higher, a breakout here. You know, yes, it stops you from kind of snatching at profits, and it is possible to use. I prefer it on a daily, if I'm honest, because I feel that, you know, that's where it has more power. However, you know, if you're in a really, really trending day, in those days, sometimes, specifically on the indices, where, you know, they open and they just trend and trend and trend, and you're one of those people who wants to snatch the profits, plug that on, stick your ATR trailing stop on, take some scales out, and then leave the thing, go, right, well, I'm either going to get stopped out, it's going to alert me, or I'm going to close at the close. And that might just be enough to have those outlier days, you get those kind of extra 100 points, extra 150 points on a day trade. Like I say, I prefer it on a daily chart personally. I think it's better for that. But the whole tool and the whole reason of the tool is to keep you in trades if you're struggling to stay in trades. Perfect for that final runner. You know, you've scaled out a position, you've got a little bit left, leave it, see what it does. You might find, you get a really nice move out of it. You might find it kind of pushes up and stops you out, with not much extra. Obviously, that's the market, that's the way it goes. But worth having a look at, worth checking out. And like I said at the beginning, guys, this video is sponsored by our friends over at CoreSpreads Australia. Go and check them out. There is a link to them in the description below. And I was on the CoreTrader 2 platform. That's the charting within the CoreTrader 2 platform, which is the platform that has their tightest spreads. So anyway, guys, take care, keep your risk management, whatever you're doing, and check out that tool. Check out that little indicator. Take care, bye-bye.